Hey guys, today we'll talk about very important topic which I feel is not discussed enough in the trading world, and it is trade management. So basically how to manage your risk, how to manage your trade, how to manage your stop loss, take profit orders. These are all crucial things if you want to be a profitable, successful trader. This topic is crucial for any trader's success, but I feel like it's not covered enough in the industry. So today we'll talk about trade management. So here, as you can see on the chart, I have a position. This is a long position, so we bought the markets because if the market will go upwards, we'll be in the green or in a profit zone, and if the market will go downwards, that means that we are losing money. And you know that we have take profit orders, which is our target, and we also have our stop loss orders. So before anything, we have to understand what do these orders even mean. So first of all, if you would be trading without a stop loss order, imagine that you open a position right here. So price is in the middle, and you leave the trading desk, or you go to sleep or anything like that, and you wake up and imagine that the price is currently over here. And if you would be trading without a stop loss, you over here, you could potentially wipe out your whole account. So imagine opening a position, going to sleep, and waking up to actually zero in your balance. So it depends on the risk that you're taking. So it could be losses of hundreds, or losses of thousands, or even tens of thousands. So the first and the most important rule is always use a stop loss. And for traders that are new, I actually seen that a lot of traders that are just starting out, they like to do this mistake of not actually using a stop loss. So please use stop loss. It will potentially can save your whole capital and can save you tons of money. So now we got this out of the way, but how about take profit? Should you use take profit target or not? Well, in my personal opinion, I think you definitely should, because the markets are volatile. At one day you can be in profit, or at 1 week you are going in profit, you're making a lot of money, and the other week, boom, you can go into break even, or you can go into the loss. So in my opinion, perfect trading is actually having your target, actually planning the trade. So you plan your stop loss, you plan your target or your take profit, and then hopefully the market hits your take profit, and that's it. You exit the position. If you will be basically opening positions and praying that the market will go upwards and you will have no take profit, you will be trading without take profit, and you will be expecting to make thousands and tens thousands of dollars, so basically 100x returns on what you're trading, you will not be a trader, you will be a gambler. So remember that gambling is basically trading without a stop loss, because that's total gambling. And trading without take profit, also what I would consider is gambling, because then you are not planning the trade, you are not looking at your tools, you're not doing anything right. So this is the first thing that you must understand. Always use take profit and stop loss. So now we can go into more specifics and talk about how big your stop loss or how big your target should be. Well, I can tell you that it definitely depends on your preference. If we are talking about pips, because we can measure positions in terms of pips, or in terms of percentages, or in terms of dollars. So in this case, let's measure it in pips so it's easy to understand. So the first thing that you should know, that there is no like perfect stop loss or perfect take profit. It all depends on your strategy, on the type of trading style that you use. So if you are a scalper, you will be probably using stop loss of 10 pips, or even smaller, or even 5 pips stop loss, because you will be trading on very short time frames and very small targets. If you are a day trader like me, again, it's very subjective, but I personally found the golden ratio that I use to be around from 30 to 50 pips. So because if you will be using 20 pips stop loss, it will actually be too narrow stop loss, and that means that you can easily get wiped out. Imagine over here that we open a position somewhere over here, we wanted the price to go upwards, and then boom, we have a small wick going against us, and boom, that's it, we are wicked out, our position closes, we lost money. So that shouldn't happen, and that happened because the stop loss is definitely too narrow, and this is a big mistake by traders as well, using too narrow stop loss, because they're thinking, oh, I will not have to risk as much money, I can have bigger risk reward ratio. But in reality, you definitely need wider stop loss, and at least 30 pips. 30 pips is the minimum. What I like to go is either 30 pips or, for example, 45 pips, so it doesn't matter. But in this case, now if you get wicks against you or the price goes against you, that's perfectly okay, because if you are trusting in your analysis, then you will know that it will eventually move upwards into the profit, and if it doesn't, you just take the loss. So in this case, this is the best stop loss measure. So basically I measure it in pips, and the best pip count for stop loss is around from 30 to 50 pips. Now talking about take profit, well, that depends on your risk reward ratio. So if your risk reward ratio is 1 to 3, then that's great, but remember, the wider stop loss you're using, the wider take profit you will need to keep high risk reward ratio. For example, if you have a stop loss, a short stop loss of 15 pips, then to have a 1 to 3 risk reward ratio, you will only need to have 45 pips. So that's not a lot, that's perfectly manageable. But now if you want to have a wider stop loss, so the price doesn't stop you out, so imagine you are using, for example, 40 pips. Now, in order to have 1 to 3 risk reward ratio, you will actually need to have 120 pips. And now that's very hard to actually to trade with this kind of position, because it's very big and it's very rare for you to correctly predict the price to go for 120 pips. So what I would recommend is have the golden middle, that you like, that fits your strategy, that fits your trading style, and most importantly, that you feel comfortable with. So imagine if you have, for example, if you are using 30 pips stop loss, and then if you want to have a 1 to 3 risk reward ratio, you can have 90 pips. Now that's more manageable, and if that's too wide and the price doesn't reach your take profit, you can always go for 1 to 2 risk reward ratio, which will always be okay, because in this case your reward is 60 pips, which is more than enough to make you rich. So again, basically the conclusion is that you can use whatever you like. There's no official golden number which you will use and you become rich in day trading. The reality is that it depends on your trading style, and it depends what you feel comfortable with. We just have general guidelines of, for example, not having too narrow stop loss or too wide stop loss, and actually same with take profit. Don't have too narrow take profit and too wide. Always think about risk reward ratio. Trade management mainly involves managing your risk during the trade, managing your take profit orders, managing your stop loss orders, and basically optimizing your positions in the financial markets to make as much profit as possible.